Exchange-traded funds, or ETFs, are a popular investment vehicle that allows individuals to easily buy and sell a diversified portfolio of assets. ETFs are designed to track the performance of a specific index, such as the S&P 500, or a particular asset class, such as international stocks or commodities. One of the main advantages of ETFs is their ability to provide investors with exposure to a broad range of assets, while potentially reducing risk through diversification. In this video, we will explore the basics of ETFs, including how they work, what they are used for, and the various types of ETFs available. We will also discuss the pricing and fees associated with ETFs, as well as the advantages and disadvantages of using them in an investment strategy. ETFs can be used for a variety of purposes in an investment strategy. One common use of ETFs is to diversify a portfolio. By investing in a single ETF, an individual can gain exposure to a wide range of assets, such as stocks, bonds, commodities, or real estate. This can help to spread out risk and potentially reduce volatility in the overall portfolio. ETFs can also be used to access specific markets or asset classes that may be difficult or costly to invest in directly. For example, an ETF focused on emerging markets or high-yield bonds can provide investors with exposure to these asset classes without the need to buy individual securities. In addition to diversification and access to specific markets, ETFs also offer ease of buying and selling. ETFs can be purchased and sold on stock exchanges, just like individual stocks, making them highly liquid and convenient for investors. This makes ETFs an attractive option for investors who want the flexibility to buy and sell quickly as market conditions change. ETFs can help to reduce risk in a few different ways. One way they do this is through diversification within a single fund. By holding a variety of assets within a single ETF, an investor can potentially reduce the overall risk of their portfolio. For example, an ETF that holds a mix of stocks, bonds, and commodities may be less volatile than an investment in a single stock. In addition to diversification within a single fund, ETFs can also help to reduce risk by tracking a benchmark index. Many ETFs are designed to closely track the performance of a specific index, such as the S&P 500 or the MSCI Emerging Markets Index. This means that the ETF's performance will be closely tied to the underlying index, which can potentially provide a more stable investment return. Overall, ETFs can be a useful tool for reducing risk in an investment portfolio by providing diversification and the ability to track a stable benchmark index. However, it's important to remember that all investments carry some level of risk and that ETFs may not be suitable for all investors. It's always a good idea to carefully consider your investment goals and risk tolerance before choosing any investment product. There are a wide variety of ETFs available, each with a specific focus or investment strategy. Here are some common types of ETFs. Stock ETFs. These ETFs hold a collection of individual stocks, typically with a specific focus such as large-cap stocks, small-cap stocks, or a specific industry sector. Stock ETFs can provide investors with an easy way to gain exposure to a particular market or sector. Bond ETFs. These ETFs hold a collection of bonds, which are debt securities issued by governments or corporations. Bond ETFs can offer a way for investors to gain exposure to the fixed income market, and can be focused on a specific type of bond such as treasuries, corporate bonds, or high-yield bonds. Commodity ETFs. These ETFs hold physical commodities such as gold, oil, or agriculture, or futures contracts on commodities. Commodity ETFs can provide a way for investors to gain exposure to the commodities market and can be used as a hedge against inflation. Real estate ETFs. These ETFs hold a collection of real estate investment trusts or REITs, or other real estate assets such as commercial or residential properties. Real estate ETFs can provide a way for investors to gain exposure to the real estate market, and can potentially offer a source of stable, long-term income. There are many other types of ETFs available, and it's important for investors to carefully research and understand the specific focus and investment strategy of any ETF before deciding whether it's appropriate for their portfolio. ETFs are priced based on their net asset value, NAV. The NAV of an ETF represents the value of all the assets held in the fund, divided by the number of shares outstanding. This value is typically calculated at the end of each trading day, based on the closing prices of the underlying assets. In addition to the NAV, the price of an ETF can also be influenced by supply and demand. If more investors are looking to buy an ETF, the price may increase. Conversely, if there are more sellers than buyers, the price may decline. It's important to note that the price of an ETF may not always match its NAV. This is because ETFs are traded on stock exchanges, and the market price can be influenced by a variety of factors including investor demand, market conditions, and other economic factors. However, over time, the market price of an ETF should generally track the NAV closely. It's also worth noting that ETFs may trade at a premium or discount to their NAV. A premium occurs when the market price of the ETF is higher than its NAV, and a discount occurs when the market price is lower than the NAV. Premiums and discounts can be caused by a variety of factors, including supply and demand, and may not necessarily indicate anything about the underlying assets in the ETF. Like any investment product, ETFs come with fees that can impact the overall return on investment. It's important for investors to understand the fees associated with ETFs before deciding whether they are an appropriate investment option. One type of fee associated with ETFs is the expense ratio. This is the annual fee that the ETF charges to cover the costs of managing the fund. The expense ratio is expressed as a percentage of the fund's assets and is deducted from the fund's returns. For example, if an ETF has an expense ratio of 0.5% and the fund generates a return of 10%, the investor would receive a net return of 9.5% after the expense ratio is taken into account. In addition to the expense ratio, ETFs may also charge trading fees when an investor buys or sells shares in the fund. These fees, known as commission fees, can vary depending on the brokerage firm being used and the specifics of the trade. It's important for investors to understand the commission fees associated with their ETF trades, and to consider how they may impact the overall cost of the investment. Overall, it's important for investors to carefully consider the fees associated with ETFs, as they can have a significant impact on the overall return on investment. It's generally a good idea to compare the fees of different ETFs and to choose a fund with low fees, particularly if you plan to hold the ETF for a long period of time. There are thousands of ETFs available, and the popularity of specific funds can vary over time. Here are a few examples of popular ETFs that are widely held by investors. S&P 500 ETF. This ETF tracks the performance of the S&P 500, a widely followed index of 500 large-cap U.S. stocks. The S&P 500 ETF is a popular choice for investors who want broad exposure to the U.S. stock market. Bond ETF. ETFs that hold a collection of bonds, such as treasuries or corporate bonds, are also popular with investors. These ETFs can offer a way to gain exposure to the fixed income market and can potentially offer a source of stable, long-term income. International Stock ETF. ETFs that hold a collection of international stocks can be a useful tool for investors looking to diversify their portfolio and gain exposure to global markets. These ETFs may hold stocks from a specific region or country, or may be more broadly diversified. It's important to note that the popularity of specific ETFs can vary over time and may not be indicative of their performance or suitability for all investors. It's always a good idea to carefully research and understand the specific focus and investment strategy of any ETF before deciding whether it's appropriate for your portfolio. Exchange-traded funds, ETFs, offer a number of advantages for investors, but it's important to also be aware of their potential limitations. Here are some key advantages and disadvantages of ETFs to consider. Advantages. Liquidity. ETFs can be easily bought and sold on stock exchanges, making them highly liquid and convenient for investors. Transparency. ETFs must disclose their holdings on a regular basis, providing investors with a high level of transparency into the assets held in the fund. Low costs. ETFs often have low expense ratios and trading fees, making them a cost-effective investment option. Diversification. ETFs can provide investors with exposure to a broad range of assets, helping to spread out risk and potentially reduce volatility. Disadvantages. Limited control over portfolio composition. ETFs are designed to track a specific index or asset class, and investors do not have the ability to select individual holdings within the fund. Market risk: ETFs are subject to market risk, just like any other investment. The value of the ETF may fluctuate based on market conditions and other economic factors. Potential for premium or discount to NAV: ETFs may trade at a premium or discount to their net asset value, which can impact the overall return on investment. Overall, ETFs can be a useful tool for investors looking to diversify their portfolio, gain exposure to specific markets or asset classes, or benefit from low costs and convenience. However, it's important to carefully consider the advantages and disadvantages of ETFs, as well as your investment goals and risk tolerance, before deciding whether they are an appropriate investment option. In conclusion, exchange-traded funds, ETFs, are a popular investment vehicle that offer a number of advantages for investors. ETFs can provide diversification, access to specific markets or asset classes, and low costs, making them a convenient and cost-effective option for many investors. However, it's important to carefully consider the fees, risks, and limitations of ETFs before deciding whether they are an appropriate investment for your portfolio. We hope this video has helped you to better understand the basics of ETFs and how they may fit into your investment strategy. Thanks for watching.